Hi everyone, I'm Sidney McKinnon, MD and CIO of Cadiz Asset Management, and welcome again to another installment of All Things Fixed Income. I thought today I'll talk a little bit around the volatility that we are experiencing in markets at the moment. Now, the fixed income market is not immune to volatility, and as we know, things like the conflict in the Middle East has spilled over into all financial markets in terms of influencing the price action within equity markets as well as fixed income markets. But let's keep things fixed income for now. And in times like this, when there is volatility caused by geopolitical conflicts, or as I like to call it, geo-economic conflict, because I know it started as geopolitical, but there has been quite a bit of influence as a result of the geopolitical conflict that has now turned into geo-economic confrontation. In other words, countries are now starting to use their economic influence as weapons against each other. And we see this, especially with a commodity like oil, which has now been restricted in terms of its supply chain and movement through the Straits of Hormuz, and this has caused a supply chain disruption across the rest of the world, especially influencing future expectation of things like inflation, as an example. Now, when markets are volatile, people tend to panic, they tend to get agitated and frustrated, and they also tend to have lots of fear in terms of losing or reducing their capital that they have invested. Now, the fixed income markets are not immune to this. As a matter of fact, the fixed income markets pick up on these things very, very quickly, especially because bond deals, embedded in bond deals, is future inflation expectations. And if a oil price spike, for example, is going to cause fuel prices to rise, gasoline prices to rise, or any of those energy sectors to become more expensive, it then influences the future direction of inflation. And inflation expectations being embedded in bond yields will cause yields to rise and the price of bonds to decline. Now, that's the theory. In practice, this doesn't happen as a sweeping movement across the entire globe. And especially for us here locally in South Africa, we have to be cognizant about the fact that there are many factors that influence that directional movement of interest rates. Not only inflation. Yes, inflation is very big. It's an economic fundamental. And we place a big emphasis on economic fundamentals. But there are other influences as well, such as our growth, such as the volatility of our currency, the liquidity in our fixed income market, the ability to buy and sell at particular levels because of the price action within our market, the technical trends, the players that are involved, our political environment and macro environment that influences the trend as well. Nevertheless, it is very easy, and I say this generally, that people tend to latch onto an event within the financial markets, and this becomes almost a hot button. In other words, this is the only thing that matters, and it is not. However, one has got to be cognizant, because at times like these, those hot button events can turn into crises or a crisis, and they can prolong, the event can prolong for much longer than we anticipate, and I think there is the danger. Crises come and go, but we have to establish whether there has been a structural change in our economic environment to warrant price change within our fixed income environment. At the moment, I think generally the market is sitting in no man's land. We don't really know. Nobody's going to tell you that, because, us guys in the market, we think we know everything. But generally the market does not know how long the conflict is going to last in the Middle East. What exactly is going to be the knock-on effect as far as inflation is concerned? How is that going to translate into the bond yields? How is that going to translate into monetary policy by important monetary policy committees such as the Fed and our local SARB? The important thing in times of crisis is to be holistic. Look at all the factors. Don't panic. I hope this is not reverse psychology, because when you tell somebody don't do it or don't panic, they tend to panic. But keep a level head about things. Diversify your portfolios. I know there's this phrase now that everybody's using, the dash to cash to secure your assets. But be careful, because tomorrow things turn around and you lose out in terms of the uptick of the market when things calm down again. So be pragmatic. This is not a time to panic. Yes, it is a time to take cognizance of all the volatility that's happening around the world. But be pragmatic in the way in which you approach your fixed income investments. Within the fixed income universe, there's sufficient ability to diversify. As always, diversification is key. Be pragmatic and do not be reactive or fearful when it comes to risk events. Take it as an opportunity, that volatility, to be able to also maybe get into the market at levels that you would not have seen before. So my message today is, even though there is volatility in the markets, there will always be crises coming through. Be level-headed, be pragmatic, do not fear, because this will also pass eventually. But diversify your portfolio so that you can provide yourself with protection in times like these. So that's me, Sidney McKinnon from Cadiz Asset Management. Until next time, goodbye.